Okay, I think we're good. Well, good morning, everyone. Welcome. My name is Mark Keating. I am Chief Investment Officer with Willow Creek Wealth Management, and we have a timely discussion today on inflation. Uh, Before we get started, though, a few housekeeping items. We will take questions during the presentation, so if you do have a question, at the bottom of your screen, there is a Q&A box. Just go ahead and click that, type in your question. I'll be monitoring those throughout the presentation, and we'll either get to your question either during the presentation, at the Q&A portion at the end. If we don't get to your question, however, your advisor will reach out to you to have that discussion with you separately. Second, if you look at the upper right-hand corner of your screen, it says view, and there's 9 little boxes next to it. We'll give you a second there. It says view. Go ahead and click that, and then check speaker and check full screen mode. Again, speaker and full screen mode. In that mode, you'll be able to see just the speaker speaking, and then when we put slides up on the screen, you'll be able to get a full view of that. All right, so I'd like to go ahead and introduce our speaker now, Apollo Lepescu, who is a Vice President with Dimensional Fund Advisors. Dimensional's spoken with us and our team several times over the years, and I always love getting his perspective. Apollo, last time we talked, I don't know if you remember, but it was March 20th of 2020, and what a crazy time that was.
It was pretty crazy.
It was crazy, and the timing of it was, I mean, impeccable. I mean, the market, the next trading day on Monday was the bottom of the market, unbeknownst to all of us, but it was timely to say the least. So thank you for that one, and welcome back today.
Well, Mark, great to see you. And thanks to everyone for, first of all, thanks for inviting me back. And thanks to everyone for taking the time. And it was incredibly timely because at the time we were talking about the craziness, but also sort of the importance of being diversified and disciplined. And I'm so glad that in a way, the things that we talked about ended up working out quite well for folks who actually were patient and were resilient through those tough times.
Yeah, it definitely helped calm the waters. All right, well, let's get started today. So basically what we're going to do today for everyone's information, we're going to be doing a Q&A session here. I have got some pre-prepared questions, so go ahead and put your questions in if you'd like. All right, first one here, Apollo. Inflation has been a prominent topic of discussion recently, and these discussions are often tied to beliefs about the impacts of cash in the economy. Do we have any historical parallels for what we're experiencing now?
Yep. No, and it is actually quite an interesting question because in a way, I cannot say that we have a historical equivalent. I mean, the fact that in our lifetime and yours and mine, we have not had a pandemic who impacted the world the way that this pandemic is impacting us today. In that way, it is unprecedented. There is no playbook for a world in the pandemic. So in that respect, I can't say that there is a precedent. In other ways, what's interesting is that this discussion around inflation and the cash that you're talking about in the economy, in some ways, there is a precedent. And by what I mean by that is that when you look at this idea of inflation, and you hear on the news and it's presented as the boogeyman, is there to scare you. Well, in fact, the precedent that I'm talking about is that inflation is neither new nor unprecedented. So it's neither unusual nor unprecedented. Inflation has been part of our economic reality for many, many years, many years. And what inflation typically reflects is just the fact that prices increase from one year to another. If, let's say you bought a pair of speakers for your computer a year ago, and they cost you $100, well, this year they would cost more. And the average rate of increase, average rate of inflation in the US economy over the long run has been about 3%. So there's nothing really unusual about having price increases, the historical norm being about 3% per year. So that pair of speakers that was $100 last year, this year would be about $103. And in fact, it's not only that it's not unusual or unprecedented, I would argue that this is desirable for the economy. We want prices to go up. And the reason is that when you have that factory that produced the speakers, well, they might have taken a loan to build a factory, and the loan has an interest. So they need to generate more revenue from one year to another just to pay the loans. If you're a farmer, you have to generate more revenue to pay back the loans. And in Sonoma, where you are, a lot of farmers, obviously. So what's interesting is that in times when the prices don't grow, the economy can get in big trouble. It's exactly what happened in the Great Depression back in 1929. The prices didn't grow, and a lot of these farmers, in order to repay the loans, not only that they couldn't generate, the same revenue because the prices were not lower, and you can't really bump up the production, and a lot of them went into default. But if the prices go up, that gives them some cushion there. So prices going up, I don't want to scare everybody off and say inflation is terrible. No, their historical rate has been about 3%. And Mark, even the Federal Reserve, which is a central bank in the U.S., it has put a target of about 2% price increase from one year to another. So in that range of 2 to 3%, it seems that that's something that the economy has been handling. So what's interesting right now is that we hear about bigger price increases, and historically, if you go back to after the war, we haven't had many periods, and perhaps we can dive into those later, when inflation did go up. So just starting with this idea, is it unprecedented? Well, the pandemic is, but the fact that we have some inflation is not really that unprecedented. And what about the cash in the economy? Well, does that matter? Well, here's how you want to think about inflation. Inflation has to do with prices. And if you look at anything in the world when it comes to this free market society, the prices are determined by people who want to buy things. The more people want to buy things, the higher the prices go. So in a way, in technical terms, this is called demand. And demand comes from consumers, and it comes from businesses, it comes from the government buying things. And recently we had these big stimulus programs, and a lot of folks were concerned that perhaps this big inflow of cash into the economy might lead to price increases. So in that respect, people were concerned about the stimulus, and for sure, anytime you have this big deployment of cash, you want to know, well, what's going to be the impact on prices, since there are a lot more dollar bills in the economy. And you asked about the precedent. There is actually something that we can look at as a case study of what happens when we have this influx of cash. And if you go back to the financial crisis, which is only about 12 years ago, not tons of years ago, but 12 years ago, the Federal Reserve, the federal government had not only the TARP program, but a stimulus program, and that put money in the economy. But we all remember that about the same time, the Federal Reserve implemented a program that was called quantitative easing. And quantitative easing came in like three different parts, but ultimately over the course of about 5 years, between 2009 and 2014, the quantitative easing program injected about $4.5 trillion into the US economy, new money that was put in the economy. And about 10 years ago, I remember having very, very similar questions from people saying, boy, wait a second, this is terrible. This is going to lead to huge inflation. The dollar's not going to be worth as much. So that's really bad. And there were real concerns about the size of the dollar influx into the economy and what it might mean to prices. And what's so fascinating is that if you look at the period since quantitative easing was put in place, so between 2009 and the end of last year, the average inflation in the US has been roughly around 1.5%, about half the historical norm, and even below the Fed's own target, which is remarkable. And it begs the question, well, how come? Why is it that we had such slow inflation, even though we had this massive influx of dollars? Again, pretty much similar in a way with what we're seeing today. And the reason is that when you look at prices, it's not just about the demand side of the economy, but there's also the other side, which is called the supply side of the economy, meaning what is the economy's ability to produce all the things that we consume. And to a lot of folks, the surprise was that the economy had the capacity to produce even with the new dollar bill. So let's just make it real, Mark. Let's say that I'm in the business of manufacturing pens. So that's my business. I make pens. And I have some orders. I fill the orders, ship them out. Everything's good. Now, because of this influx of dollars, now I get a lot of
Can anyone hear? Apollo, can you hear me? The
Oh yeah,
sound
I
is
think I might have hit the mute button.
okay. There we
So
go. I thought it was me.
so I don't know where the last I got, but this idea, where was the last thing that I kind of before I hit the mute button? Um,
It was only like, just keep going. It was only,
Yeah,
you missed
so
like
the
15
idea is
seconds.
that it's the idea that if I reach capacity and I cannot produce the additional pens, or it costs me a lot more to hire workers or to buy materials, that's when the prices go up. So it's not just the demand side of the economy, but it's also the supply side, the ability of the economy to produce. And what we're seeing right now, Mark, that's so interesting, is that these price increases that you hear about, they're not really tied as much to the demand side, to the fact that, oh, there's so much money in the economy, but a lot more to the supply side of the economy. And why? Well, obviously, we know that there is some, shortages of chips. Car manufacturers initially didn't order enough chips for the cars, and then now there are some, COVID-related issues in production of chips in Asia, and that is leading to car prices to significantly go up. There's nothing to do with the demand side, with the cash in the economy from the government, but it has to do with the supply side. So a lot of examples like the lumber. When you talk about lumber, the prices went up when the sawmills stopped producing, thinking that it's going to be a drop in demand. When it didn't, the prices went up, and as sawmills reopened, the price of lumber dropped by 2/3 or so. So that's kind of the idea, is that a lot of what we're seeing right now is not necessarily driven by the cash from these programs as much as it is by the supply side of the economy, which is the ability to produce when we are constrained globally by this pandemic.
Oh, yeah, all great points. I remember those talks back in 08 and 09, about hyperinflation, and
Yeah.
it just never came to fruition. Okay,
By the
this
way,
next question. Go ahead.
yeah,
Sorry.
go ahead.
Oh, no, this next question kind of piggybacks off the first one. So does the size of the national debt have an inflationary effect, or is it a myth? It seems like we've been hearing this for decades, back to the crisis, or, is it just born out of the data?
Yeah, I know it's so interesting because the national debt means that we don't have enough money to spend on all the programs. So we don't collect enough revenue, so we need to borrow money to do it. So that builds up the national debt. And today the national debt is in the mid to upper 20 between 25 and 30 trillion dollars. That we owe, and that's about the size of the economy as a whole. And a lot of folks are concerned about the national debt. Well, what's interesting is that the national debt is something that it is important to look at. But I would say that when you look at just the data historically, you have countries that have been really hamstrung that by the national debt. In other words, they print money and they print money and they print money, and then when they do this, and then people start losing faith into the currency, that whatever the currency might be. That's when you see inflation really spike up and get to something called hyper inflation. So to me, when I look at this, are we in that situation that the government is printing money? Not nearly. There are very few examples in the world when that happens. The most recent one that everybody knows about is Venezuela, because Venezuela has been printing money and the inflation has been going bonkers. We're nowhere near that. And this is, again, it's not the first time that we have seen something like this. If you go back, and this is a great article that was published not long ago on our website. If you go back just like 2 decades in the 90s, we heard very similar things. This is again from the website. What you see is that in the 90s, we had this notion that all this spending is going to bankrupt the country, and we're all in terrible trouble. And yet, when you look at what the market did, the stock market did subsequent to when these claims were made, and they sounded terrible, the market actually did very well. It was up over 1 year, 3 year, 5 years, and quite significantly so. Even though when you read these headlines, you'd be like, boy, this is going to be a terrible situation for the U.S. We've been there, 30 years ago, and we're still around. We're still kicking, and it's still fine. And then you had in the 90s, we also had the same kind of issue, that the production capacity being low, and all of this is going to be leading to terrible inflation. And again, you look and read this and you say, this is really scary. And we've seen these headlines before. And yet again, you look at what the market did. What was the result for an investor? Because ultimately, that's what we want to talk about. And it was a good outcome. Even in the 2000s, we talked about the national debt, and this is again almost 20 years ago, the debt bomb, and again, the market did remarkably well even with this national debt that we had, and more recently, about 80 years ago, that again, talking about the bankruptcy of America, and we haven't seen that, and once again, the market has been doing quite well. So to answer your question, Mark, we have seen situations like this in the past. And I would say that in every time it seems like that as a country we're able to deal with it. As an investor, you also have to be careful not to be carried away with these headlines, because ultimately the market did well, and you were better served kind of staying the same thing that we talked about a year ago: discipline and diversify. Those are the two key elements that I think are important right now in this environment.
Absolutely. Okay. Next question: is the recent inflation the result of a supply side problem, an increase in demand, or both? And in which areas of the economy are we seeing the most inflation?
Yeah, it's interesting because it's hard to pinpoint precisely what part comes from where. But I can tell you that last month, we're in July, by now we're in September, there was a report looking at the price increase from last year, 2020 to 2021. And over 12 months, we had a pretty big inflation increase of about 5.4% or so, which is above the historical average, quite a bit above the historical average. And a lot of folks were wondering about, what might have caused this. And again, it's not easy to pinpoint and say it's because of demand or supply. What we did see in that report that was fascinating is that about a third of this price bump was caused by used cars. Used cars was a huge reason why the prices bumped up so much. Now, can you attribute that to the demand side, or more of the shortages of chips on the supply side, and the fact that we're still dealing production-wise with the coronavirus? Again, I'm not an expert, but intuitively, I would say it's more on the supply side. You had also price increases in restaurants and airline fares, and of course we expect that, because from a year ago, when nobody else was going on a plane or eating out, now that we're all kind of getting on planes and going out, of course prices are going to go up until until the production and the planes go back to the normal routes that they used to have. So it's hard to pinpoint, but it does seem intuitively, just looking at the headlines out there, that a good chunk of this, it is caused by supply issues. And then on top of that, you have shipping problems that, here in Los Angeles, so many folks got sick that there are not enough dock workers to unload the ships. And so many ships are waiting for a long time to get their merchandise unloaded and put on trucks. Speaking of trucks, there are big issues with trucking and distribution of and transportation. So all of this is kind of suggesting that it's not clear at all, but it doesn't appear to be, it's really driven by the cash flow. It might be a balance, but the reality is that the supply side has a lot to do with this. Now, what's fascinating is ultimately we have to ask, well, what's going to happen down the road? And that's what people want to know. What does it mean to me? I can tell you folks that historically in the US, if you go back to the 50s, we really haven't had more than two distinct periods when inflation was quite high. We had in the early 70s, and we can talk about it, and we had it in the late 70s, in the early 80s. And those they tended to be much more driven by the supply side than they were by the demand side when we had this big inflation. And what's interesting is that if you look right now, what's going to happen, and people being scared about losing the purchasing power, which is a great concern for a lot of retirees and folks. What I can tell you is there are two different narratives. about what's going to happen down the road. On one hand, you have some folks who are kind of saying that this is a transitional phase. And right now we're not producing. The supply side is really constrained. The shipping, all of these things are leading to prices going up. And when these supply chains and shipping routes kind of start going back to normal, and all these price increases are going to fade out. So this is a transitory period when we might see higher inflation, but then beyond that, it's going to go back to normal. You have a second narrative, a second group of people who are telling you, you know, this is going to last a lot longer. Once you get on this path, it's going to start snowballing and the prices are going to keep going up, and inflation might be here on a higher level to stay for a longer period of time. And when you look at it, Mark, right now, it's actually impossible for anybody to say which one of these two will come true a year from now, 2 years, 3 years, whatever. We all have an opinion about that. But what I'm going to suggest to you is something beyond an opinion. There is something that I think of as a referendum every single day in the market when investors are voting with billions and billions and billions of dollars. And these are very sophisticated investors, and they're voting with all these billions of dollars. And some of them are on one camp, some of them in the other camp. And what they're putting out in this referendum is not a forecast, but rather in the way that they buy certain types of bonds, they are sending a signal onto what all these participants as a whole, not just the narrative one or narrative two, but combine, what do we expect inflation to be over the next 5 years? And that is in the way that certain bonds are priced. And that metric is available for all of us to see. That referendum is available for all of us to see, and the numbers are published by the Federal Reserves. And that metric is called the break-even inflation rate. So this is a live website, the Federal Reserve of St. Louis live website that looks at the 5-year break-even inflation rate. So what is this? It sounds like a big word. It kind of says it right here, is what market participants expect inflation to be in the next 5 years on average. So over the next 5 years, if you look and say, what do I expect inflation to be? And it could be the first narrative, which is, I think it's transitional, is going to go back down, or it could be it's going to stay with us on a longer term. So what do we see out there? What's the signal that the market's sending? Well, if you go back 5 years, you see that the inflation was in between 1 and 1.5%, so very low. And then it went into 1.5 to 2%. And then when the pandemic hit, it actually hit a very low point where people were afraid that the prices might not grow at all. But as the economy reopened, stimulus kicked in. Where we are today, as of last night, this is last night, the Tuesday, August 31st. Over the next 5 years, the signal from the market is that inflation will be about 2.48% per year over the next 5 years. So to me, what's really fascinating is that this is, again, not a forecast. It's a market signal based on how bonds are being priced, based how they spend the dollars in buying different types of bonds. And the signal that we're seeing is that the market participants are seeing higher inflation than we have had over the past 5 years. But it's in the 2 to 3% zone that doesn't look catastrophic. It's not what we used to be in the 70s or early 80s. It's in the 2 to 3% range. And in fact, if you extend this time series that's published on the website to the beginning of the series, what you see is that the anomaly seems to have been the low period where we're in for the last 5 years. And where we are today is in line to where we've been years and years in the past. So nothing tremendously different. So it is going to be higher than we've had in the past, but not in a horrific zone, but rather in the happy 2 to 3% place. And that's the signal that we're hearing from the market. And to close this, Mark, this is something that everybody's paying attention, and this adjusts every single day as new information comes out about the stimulus, about the supply chains, about the demand, everything. And at the beginning of the year, you see it was roughly about 2% or so. And as we got back to the normal economy, by May, we had an expectation of 2.72. So it went up from 2 to 2.72. And then it went as low as about a 2.3. And where we are today is about 2.48. Yesterday was 2.51, 2 days ago. So in other words, this is a metric that changes all the time. And this is, to me, probably the best market signal that we have. Not an opinion piece, not an op-ed, not a post, but rather how investors vote with all their money when it comes to buying these bonds. And the signal that we're seeing is that that it is about a 2 to 3% over the next 5 years. And then if you look beyond that, we do see it tapering down back to about 2%. So what the market signal is that they see this as a temporary increase, and then beyond that, we're kind of going back to the Fed's desired interest rate, and not interest rate, but inflation rate.
Got it. Okay, we're actually getting quite a few questions from the audience here, so I'll combine a couple of questions here. Number one, what is the effect of level of inflation on the bond market and bond funds? And what have been the best investments to hedge against inflation? Gold, commodities, stocks, bonds.
Yep. So the inflation impacts interest rates because in a very just intuitive way, when I buy a bond, I basically lend my money to somebody else, let's say the US government. So one of the first things that I want to do is I want some safety on my money, but I also want to make sure that I stay ahead of inflation. So as inflation goes up, I, as an investor, might not be willing to accept a lower rate if I know the inflation, if I expect inflations to go up. So I might be like, I'm not willing to accept the lower rate now that I see inflation going up. So you might have to pay me a little bit more. Conceptually, bond yields, the interest rate on bonds, does change with inflation. So you should expect that as inflation kicks up, so will some of these bond yields. And that's exactly what happened in the 1980s. In the 1980s, as inflation was going up, so did bond yields. I mean, there are some government bonds they were paying maybe 15% or so to investors, but inflation was right up there. So you always have to think, as an investor in bonds, not only in terms of, what do I get paid, but also what do I get paid beyond inflation. And probably the easiest thing to see this visually is if you look at probably one of the safest investments out there. You lend your money to the U.S. government, you get it back after 30 days plus interest, and that is called the U.S. 30-day Treasury bill. So if you go back, since we have good data in 1920s, what you see is that this is a matrix of what would be the average annualized return that you would have gotten on these treasury bills between different years. And the long story, we're not going to go through these numbers, but it's just a visual. If you see black, that means that investors did not lose money. So you made money in those years, or at least you broke even. And now the thing is that if you see red, that means that you lost money. So this is what you see, irrespective of inflation. So when you don't consider inflation, these treasury bills have done really a good job of keeping your money safe in a way, because there's not a year when you see, boy, I would have lost money. Now, if you now take account of inflation and say, how much would I have made when I account for inflation, when it becomes a very different story. The same chart has a lot more red. If you see, there are tons and tons of red, meaning that some of these treasuries did not keep up with inflation. So they might have been safe in what's called the nominal sense, that you didn't lose money, but when you account for inflation, you might actually have seen some losses. So there's a lot of red, meaning that there are a lot of periods when these bonds did not even keep up with inflation. So conceptually, the inflation goes up, bond interest rates go up, but not always to keep pace. And why? Because sometimes investors really say, okay, I'm okay if I don't cover my inflation, as long as I feel like my money's safe to get it back in 30 days or a year or so, or 5 years. And in that respect, they might be okay receiving below inflation. But for an investor, as you see this is not necessarily a stellar way to preserve your purchasing power. So if that's the case, then to the second part of the question, what are some of these investments that keep up with inflation quite well? Well, I would say that one of them is certainly conceptually the stock market, because in the stock market, if prices go up, well, in those cases, company revenues go up and the value of companies go up, and that goes the upward movement in the stock market. So certainly intuitively, it makes sense that the stock market as a whole, not any one single company, as a whole, would do a pretty good job, keeping up with inflation. The other investments that can keep up with inflation, rather than look at sectors, like sometimes you think of energy, could that be? There's no real evidence to suggest that, but there is a category of investments that are called inflation protected securities, or TIPS, Treasury Inflation Protected Securities, if they're issued by the US government. And what they do is they adjust the value of the principal to reflect inflation. So if the inflation bumps up quite significantly, the value of the principal goes up. And if you have an interest rate that you receive of that, the payment that you get would also be adjusted, therefore, for inflation. So in other words, these have a good way of protecting you against inflation. If that is your ultimate goal, if you really care about inflation, these are good instruments. Alternatively, one of the things that we've done is also take some regular bonds, but on top of that, put some inflation hedges. And these are some instruments in the market that you can actually hedge against inflation. So as inflation goes up, those are going to give you a bump through to compensate for that. So these are, when in terms of investments, I would say that the stock market conceptually can do a good job. Inflation protected securities tend to have probably one of the better ones, and the third one is maybe some funds that have an inflation hedge. If you look historically and you look and say, well, what about these periods of high inflation? How would I have fared? What is high inflation? Let's just get that on the table. When you look at high inflation in the US after World War II, we've only had these two periods of high inflation. The first one was around 1970s, the early 1970s. And back then, inflation went up about 8.7% in 73 and 12.3. So why is it that we saw that big inflation? And is there something here today that would kind of make us think that we're in the same position? So it is important to know what's high inflation. It's not in the 100%. It's not in the 50%. It's in the low double digits. So why is it that we saw this inflation back in the 1970s? Well, there are three factors that drove inflation back then. The first one is the fact that back in 1971, we decided as a country, and it was during President Nixon's term, that we will actually cut the link. We will sever it, as it was put, the link between dollars and gold. So we used to have something called the gold standard, where every dollar, in order to be printed, it had to have some gold backing. And back in 1971, we moved away from that, and we said, no, we can print dollars even though we don't have gold. The type of money we have today, which is called fiat currency, only backed by the faith that we have in the dollar and the government. Now, when that happened, they put in place a 90-day wage and price freeze. So you could not increase prices and wages. And there was supposed to be a 90 days, but interestingly enough, it wasn't until 1973, about a year and a half later, when these ended. So when you end this after a year and a half of pricing being repressed, well, obviously, when you see this, the prices are going to go up. So the first thing that we had in the 70s, which is remarkable, is the fact that the public, changed from a dollar that was backed by gold to the type of money we have today. The second thing that happened is 1973, there was a crisis in the Middle East. And to show their displeasure with us, OPEC put an oil embargo against the US, which led to a tremendous energy crisis. I was talking to my father-in-law not too long ago, and he was telling me about this, and he might have been one of the guys in the car here, and wait for hours at a gas pump. And then, by the way, he was saying that back then, by the time he got home, he had to go back and refill because there weren't exactly fuel-efficient cars. So we had a huge energy crisis that impacted the entire economy. And then thirdly, we had a global food shortage because of a drought, and that led to really big increases in insufficient supplies and big increases in the price of food. So what we're seeing is that back in those days, the inflation was quite high, and it was caused again by these three things. Now, coming back to the question, we also know that the same inflation was up in 79 and 80. So the reason I'm kind of bringing back is because we had these two periods of high inflation, 73, 74, 79, 80. And the question is, how did the stock market do? How did it help investors or not help investors? Well, in 73, 74, that all these situations, moving from the gold standard to the current dollar, but particularly the global energy crisis had a tremendously negative impact on the stock market. So you can say that, look, inflation is high, the stock market might not do as well. Yet when you look at 79, 80, which are the two highest inflation years in modern US economic history, in those years, the market didn't do just well, it did remarkably well. Almost twice the long-term average, or sometimes more than 3 times the historical average in these periods. So it's a mixed bag. I can't say that inflation's high, the market's going to do well or bad. It seems when you look at the evidence, it's a bit of a mixed bag. It could do well. It just really depends on what are the other things that are going on in the world. And when you look at bonds, Mark, what you see is that a broad government bond index did pretty well and did not afford losses to investors in those years. So it's a mixed bag, and I think that as an investor, if you want to protect yourself, I think the best thing is to consider that when Willow Creek, when Mark and the team put together a plan for you, they did bake in some inflation, and having a portion of your money in stocks, not just US, but international developed emerging market stocks, having a portion of your money in bonds, having a portion of your money in real estate stocks, that is actually a really good way to try to mitigate and protect the purchasing power. Now, for some of you who are really, really concerned by inflation, there are some instruments, as I said, Treasury inflation protected, or some funds that have an inflation hedge that could also be useful to you.
Yeah, that's great points. I mean, interesting looking at those returns in the 70s and those high inflationary periods. I mean, it just goes to show again, just how unpredictable the stock market is. I mean, we're seeing it now with what happened with the coronavirus and back then. So predictability is very low in the market, no matter what's going on.
Right. And it's not the first time. You're again, look at the numbers that I showed you earlier. The market did really well, even when there are very, very big concerns about inflation.
Yeah. Okay, another question from the audience. So going back to the chip shortage, what do you think will be the effect of China assuming total control of ARM, a major supplier of semiconductors?
Well, I think that I can't pretend to be an expert in policy, but what I can tell you is that just recently you heard more and more about strategically having a U.S.-based production of chips, and particularly when it comes to national security and other interests. So there is certainly a move right now to look not just at chips, but there are all these metals that are rare metals that a lot of them are coming from China, and those would be nice to have some local production. So there is more of a consideration now to manufacturing in the U.S. And recently, again, just looking at the news, Intel announced that they are no longer just in the business of designing chips, but they also will have a foundry to produce the chips. So I think that's one way to think about it. Secondly, a lot of these chips are not as centralized in China, and depending on the type of chips, there's some of them like the biggest chip manufacturers actually in Taiwan, not in China, Taiwan Semiconductor, and then you have others in Malaysia, which right now, because they're not doing it well with COVID, is impacting. So it's a little more decentralized, but ultimately, what I would say is that for folks who are concerned with China, I think there's a lot of concerns that are there, and I'm not here to elaborate on all of them. My personal feel is that there is a balance there in everything that I've seen so far. There's a balance, because as much as the Chinese or the Americans want to assert dominance, want to put out there, that we are dominant, everybody still relies on each other. If the Chinese don't have the U.S. market, they're not going to be in a good shape, because they have a lot of people to feed and they're getting a lot of revenue from the US. So to say that we'll smash and we're not going to do that, and if you break some of these trades, again, it's not necessarily going to hurt the US, but it would also hurt China. So I think there's an interesting tension there, because in some ways, as you said, maybe the chips are coming from China, we're dependent on them. On the other hand, they're dependent on us, because if we don't buy those chips, all those workers are going to be out there screaming their heads off, and that's not going to be pleasant to the government. So I think there is an interesting one, but I think that there are multiple facets to your question, all interesting. I wish you had more time to explore all those.
Right. Okay. Is there anything about the current environment and the risk of inflation heating up that would cause you to change your portfolio?
No, not because of inflation. I would say that the only reason that I would change my portfolio is if something happened as a circumstance. And when I say no, I'm talking about my personal situation. But I would say for your situation, it depends. One of the things that has been interesting is, I've talked to a lot of business owners who right now inflation is not necessarily impacting them just directly, but indirectly. And in some cases, I know one friend of mine who was here who makes tubs, and he was telling me, because of the supply chain issues and because of some of the increases, some of them temporary, he might be actually forced to either shut down, or his company's prospects are not as good just because of the supply chain issues. And in that case, if you get to a point where in your personal life something changes, a circumstance changes that might have been caused by inflation, maybe not directly, then maybe it is worth revisiting the plan. But that would be because a circumstance changes. You used to have a business, you no longer have a business, or you maybe are, on the other hand, you didn't have a business, but because you see prices going up, maybe you want to jump in and build a business. Once again, that's a circumstance that might warrant a change in the plan. But just because, again, inflation today, folks, it is not scary. When you hear this 5%, yes, but it's 5% from last year, when prices are rock bottom. And again, think of what drove this 5% increase is used car prices, airlines, food, things that last year were non-existent pretty much. When you look at it, and particularly when you look at the break-even inflation rate, there is no signal out there to tell you that, boy, this is going to be a terrific, horrific inflation. And no, it seems like this is going to be something that will be there in the short run until this pandemic starts easing off, and then we go back to the same type of supply. But there's no reason to believe that we won't be able, as a global economy, to go back to those supply chains. And if those are concerns, they will be reflected into that break-even rate. So I will not change anything right now unless the personal situation changes. And that might be a good thing for you to talk to your advisor. Just go and say, hey, listen, let's revisit. What were the assumptions for inflation that we baked in? Are those still realistic?
Yeah, absolutely. We can address that with you, the audience, at any point. Okay, we have our last question from the audience. I'd like to commend the audience. Actually, you've given great questions today. So the last, is inflation always bad? Can it be good under some circumstances? And at what level might inflation be uniformly bad for all?
Absolutely, a great question. Inflation can be good. It is absolutely true that inflation can be good. And inflation can be good in the sense that I described earlier, that it allows firms to increase revenue so they can start paying off their debts, that they can increase perhaps their revenues. So in that respect, inflation can be good. The historical range has been about, again, 3%. The Fed's desired target's about 2%. So, you know, just if you ask me personally, I believe that 2 to 3% inflation is actually healthy. It's good. It's not really detrimental. You're not going to feel it as much. And a lot of times it is baked into these into contracts or Social Security and so forth. So a lot of them are baking in some of this inflation at about 2 to 3% rate. Since World War II, we have had an incredibly stable inflation, except for those periods in the early 70s and early 80s. Outside of that, we have had an incredibly stable inflation. And one thing that is with us today that I believe is hugely important is the fact that inflation is not only driven by supply and demand. We talked about that. That's absolutely a component of what drives inflation. But there's another component that drives inflation that is more driven by human nature and by emotions. And you talk about bad inflation, and is there a level where inflation can be bad? Well, it turns out that the human nature and emotions can be really detrimental, not because it's not just the supply and demand. I'll give you an example. In the early 80s, inflation was running quite high. It was about 10-15% in the US, so very high inflation. And it's very unusual. I mean, people don't like that high level of inflation. But what happened is that people started believing that the Federal Reserve is not really willing to act and inflict some economic pain, because when you want to reduce inflation, one of the things that you can do is really increase interest rates or do something to restrict economic activity, and that brings prices down. So a lot of folks are saying, you know, the Federal Reserve is not really willing to do so. And the way it manifested is that you know, I'll take an anecdotal example with the Fed chairman, Paul Volcker at the time, meeting with a bunch of business folks and asking them, what do you think about inflation? And all of them basically said the same thing. It's like, listen, we think inflation is going to be about 15%. Everybody knows it's going to be about 15% for the next few years. So when we run our negotiations and run our contract to the union, we baked in about a 12% increase in their pay to offset this inflation. So think about this. They already baked in the contracts a 12% increase in wage or something like of that nature, just because they thought that inflation is going to be about 15% or so. So why is this a problem? Well, the problem is that it becomes a self-fulfilling prophecy. You know, this is a high inflation, and if you believe that's going to stay high, that's going to reflect in the contracts that you write over the next few years. And what Paul Volcker did, that you know, to some degree was good and to some degree is bad, was he changed that perception. He basically said, you know, I know it's going to be painful. I know we need this medicine, but we're going to restrict economic activity. And we went through a very bad economic period. But people start being persuaded that the Fed is not kidding. If they want to cut the inflation, they will be willing to take these drastic measures. And once the expectations that people had started to change and be like, you know, I do think that the Fed's not kidding when they're saying they're going to take care of it. Then from that point on, what you saw is that the expectations, the behavior, the emotions that people had were different than before Volcker. So to me, when you look at inflation, I think that if in this range is good. If it goes up, I think that you know, people remember that the economic pain, but the fact that the Fed didn't shy from adopting measures to reduce inflation, and right now what you see is that for most people that I talk to, is that they don't expect inflation over the long run to be so high, and that matters. Because those expectations ultimately get put into contracts, they might last longer. So as long as those are the expectations and the emotions that we have around this are kept in check, that is one of the big things that would help, you know, keep inflation in check.
Gotcha. Okay, we actually have one final question, and then if you want to provide any final comments, that'd be great. This piggybacks on the last one. If wages go up at 12% in response to an expectation of inflation, what happens when inflation lowers? Since wages rarely get reduced to what they were before the inflation adjusted increases.
No, but so at that point, typically what happens is once that contract gets done, they don't roll for the next few years at the same rate. So it might be a period of inflation when you're going to have pretty high inflation because these contracts are high. But once inflation starts going down, at that point, the new contracts will not reflect the high inflation. So the wage increase after that is going to be much more reflective of what the new expectations are. And even again, I have people here in Los Angeles who are writing contracts for restaurant leases, for example, and the baked in inflation expectation that they are putting in their contracts is about 2.5% for the next 5 years or so. And I'm not sure if it's tied into the the break-even rate that I just showed you, but that's typically what sort of again, I'm not going to say across the entire economy, but that seems to be right now. And obviously it could change, but that's the beauty of that market, is that as it changes, these numbers are also going to change in the market.
Great. Any final comments?
I mean, the final comment is something that we talked about last year, but I think it's also important to reiterate this time around, is that we have had just a horrific year and a half, and you folks, particularly up in Northern California with the fires and everything, it's even been worse. But focusing on this pandemic that has been dominating us, it's in a way, it's, as I said in the beginning, it's hard for me to relate. It's hard for anybody on this call to relate because you've never had to live through that. And the closest that I ever got, and I think we talked about it last year, was the Spanish flu pandemic of 1918. And when I first heard about that, Mark, my thought was like, boy, we can't really compare because that was 100 years ago. The world was very different back then. And I kind of tended to discard it. But then as I start reading more and I start getting into sort of like what happened back then and how is it relevant, what I realize is that I cannot relate to it. My parents cannot relate to it. But if my grandparents would be here, they would pat me on the back and say, oh, grandson, perhaps as a country, we have seen something similar. So if you go back to those days, the pandemic started pretty much like this time around in the Northwest. And the way that we reacted as a society was by doing some of the same exact things that we are doing today. We closed churches and schools and indoor activities. And it wasn't just in Seattle. It pretty much went around the country. There were quarantines. And the advice that we got from the government was pretty much the same. Stay away from sick people, and don't get into crowded cars, and wash your hands. And not only that, but even to the point of keep church windows open. So being outdoors, who's going to get the shot first? The draft meant to be inoculated first. And what's fascinating is that this is so remarkable. This is a picture from 100 years ago. Look what these people were doing. They were getting a haircut outdoors while wearing masks. Pretty much like we're doing, not me, but my kids, people we know, that's what they're doing. They're getting haircuts outdoors while wearing masks. This person wasn't allowed on the train because they didn't have a mask. This is San Francisco, where they're holding court hearings outside just because it was safer. It's remarkable that as a country, perhaps we went through the same thing. And even like when we have this debate around masks, they had it back then. There was a group saying wear a mask or go to jail, but there was also an anti-mask meeting. Police was not just wearing the mask, but they're enforcing them, back in those days. So it is incredible how similar. And even if we look and say, well, today we have all these online delivery and we have entertainment at home and we have, all the things that we do today. Well, funny enough, they had something similar. You can, help fight the influenza by staying at home and shopping by phone. So don't go to the store, have it delivered. The same thing that we do. When the theaters are closed, well, you can buy this device that the dog is staring into, and you can have entertainment into your living room. And by the way, you don't need Zoom. People who are in quarantine are not isolated if they have a Bell telephone. It brings cheer and encouragement to the sick. So they had a very similar experience that we're having today. And it's just that it was 100 years ago, and my grandparents are not here to again, to kind of, look at me and say, perhaps we have seen this. Roughly the same number of Americans died back then as they did this time around. And what's remarkable is to think about what happened afterwards. And there's no real economic data to say, well, when this happened, the economy grew up. We just didn't collect good economic data. And by the way, to be sure, there are differences, no doubt about it. We're in the war back then. The world was different. It's just remarkable that some of these similarities we would recognize today. But what came afterwards is what interested me. So what happened after the pandemic once we got done with it? And what happened was something that we know today as the Roaring 20s, which was, incredible. The cities, the people went back to doing what they're doing, get a beverage. So much so that prohibition came along. Manufacturing took off in a big way. Cities came back to life and they're vibrant again. But it's not just the cities. It was one of the most vibrant decades in American history. And it was right after the pandemic. And to me, what's fascinating is to think about the resilience that our grandparents had. Our grandparents were resilient. The companies were resilient. The stock markets were resilient. There's so much resiliency back then. And I have no reason to believe, no reason to doubt that we won't have the same resiliency today. And I do really, I'm incredibly optimistic because you do see it this year as opposed to last year. Everybody's chomping to go out there and do something. There's so much pent up demand. There's no reason for me to believe that we won't be able to go into something that might be the Roaring 2020s.
Yeah, I like
but
it.
something that, again, if you look at our grandparents, they were resilient enough. And as a country, it was one of the most vibrant periods in American history. So I am incredibly optimistic about what comes next. And I know we've had an incredibly hard year and a half. I just think that there's no reason for me not to be optimistic about the future. And it's, the pain is through all the folks who did not, make it. People got sick, the long haul, all these things. But as a society, as a whole, I have no doubt that we are in a better position today than they were 100 years ago. So that's kind of what I want to close. It's just I'm an optimist, and I do think that there's a lot of great stuff coming down the pipeline for all of us.
Great closing remarks there. Well, Paulo, thank you. I mean, I always appreciate your perspectives on everything with the economy and the markets. So, on behalf of everyone here at Willow Creek, just want to thank you once again for coming out to speak with us. And you always do such a wonderful job.
It was great fun, and I look forward every time.
All right, great. And finally, thanks to all of you who joined us today. We will be doing more of these in the future. So looking forward to seeing you next time. Enjoy the rest of your day.
Bye-bye.
Bye, everyone.